Good morning, good evening, good afternoon. We have another big week for Chainlink behind us. Maybe even one of the biggest in Chainlink's history. They dropped a major announcements that show exactly why this project continues to sit at the center of the entire on-chain economy. The US government drew the lines that institutions have been waiting for. Europe's largest asset manager went live on Chainlink rails, and a tokenized private credit fund launched across 6 global markets powered by CCIP. Let's go through all 3 because each one on its own is a big deal, but of course if you combine them together it's an even bigger deal. Before we dive in, you better subscribe for some good luck on your portfolio. On March 17, the SEC and the CFTC jointly dropped a 68-page regulatory framework, officially ending what they called a decade-long era of enforcement instead of regulation. For over 10 years, crypto companies in America were essentially playing a guessing game. You built something, you launched a token, and then you just waited to find out if the SEC was going to come after you. That was the regulatory strategy. Just hope for the best. SEC Chairman Paul Atkins said it himself at the DC Blockchain Summit just minutes after the release dropped. We're not a securities and everything commission anymore. The rule establishes a formal taxonomy for crypto assets under federal securities laws for the very first time ever, sorting them into 5 categories: digital commodities, digital collectibles, digital tools, stablecoins, and digital securities. The first 3 categories are explicitly deemed non-securities. The only bucket that stays under heavy SEC oversight is digital securities, basically traditional securities that happen to live on a blockchain. And everything else? Clarity. Finally, the SEC named 16 specific assets as digital commodities, including Bitcoin, Ether, Solana, XRP, Cardano, Avalanche, Polkadot, Chainlink, Dogecoin, and Shiba Inu. Link is on that list officially legally in writing. The definition of a digital commodity under this framework is a crypto asset that is intrinsically linked to and derives its value from the programmatic operations of a functional crypto system, as well as supply and demand dynamics, rather than from the expectations of profits from the essential managerial efforts of others. That description fits Chainlink like a glove. Chainlink's value comes from its role in operating the Oracle network, from staking, from real usage, and not from a team promising you returns. The document also clarifies how activities including staking, protocol mining, airdrops, and wrapping will be assessed under existing legal frameworks. And the short answer is, most of them are not securities transactions. Protocol staking, clear. Wrapping links across chains, clear. Running a node, it's all clear. The ink wasn't even dry on the SEC announcement when the second story dropped. On March 19, 2 days after the regulatory news, Amundi, which is Europe's largest asset manager with 2.3 trillion euros in assets under management, went live with a tokenized mutual fund alongside Spyco called Sappho. Sappho uses Chainlink for automated NAV reporting and secure cross-chain interoperability, launching with $100 million in commuted AUM under a EU-regulated UCITS structure, backed by fully collateralized total return swaps. Let me explain what this actually means in practice. Chainlink is used to record the fund's net asset value directly on-chain, providing near real-time valuation updates. By publishing NAV on public networks, the fund's valuation process becomes more transparent and easier to verify. The fund is available in 4 currencies: Euro, US dollar, Pound sterling, and Swiss franc, and is built on both Ethereum and Stellar. Now, what makes this launch different from the proof of concept pilots we have seen before? The $100 million in committed AUM at launch is not a pilot figure. Many tokenized fund launches begin with far smaller commitments. Starting at 9-figure signals that the institutional demand behind Sappho was in place before the product went live. Chainlink's chief business officer, Johan Eid, put it very clearly. One by one, every tokenized asset is adopting the Chainlink standard, amplifying the network effect and distribution by the day. And then on March 18th, a third announcement landed. This one flew a bit more under the radar, but it might be the most interesting one out of the 3 from a product perspective. EPOCH Digital Credit, a leading institutional private credit manager in partnership with Synthesis and Chainlink, announced the launch of Treasury Plus, or T+, the first digitally native, institutionally managed tokenized private credit fund with traditional fund administration across 22 distribution channels from day one, across 6 global financial markets. Those 6 markets are Singapore, Hong Kong, the United States, the United Kingdom, Europe, and the UAE. T+ is built on Chainlink's cross-chain interoperability protocol, or CCIP, and its digital transfer agent standard. These tools allow the fund to operate across multiple blockchains simultaneously without duplicating structures or adding unnecessary intermediaries. The fund is launching natively on Ethereum, Stellar, and with further integrations planned across Avalanche and Canton. T+ is designed to generate consistently higher yield than money market instruments while maintaining the potential for 24/7 liquidity on-chain through stablecoin subscriptions and redemptions. This is the next step up from tokenized treasuries, private credit, institutional grade, global distribution, all built on Chainlink from day one. So here's the thing, all of them are very impressive on their own, but what is striking about this week is that they all happened simultaneously. The regulatory clarity from the SEC and CFTC removes the legal uncertainty that has been slowing institutional adoption. The Amundi launch shows that Europe's largest asset manager is not waiting around and are actually already live, and the EPOCH fund shows that tokenized products are now being structured for global distribution from day one and not as pilots. The tokenization of real-world assets rose from $15.2 billion at the start of 2025 to nearly $52 billion by March 2026. This is more than a times 3 in just over a year. One of the biggest hesitations institutions have had about building on Chainlink infrastructure, CCIP, proof of reserve, price feeds, was the lingering legal uncertainty around the Link token itself, and now that uncertainty is gone, you can build on Chainlink rails with the regulator-approved commodity at the center. So I've been covering Chainlink on this channel for a while now, and the bull case has always been straightforward. Oracle infrastructure becomes critical once the institutions come in at a scale. The whole RWA stack runs through Chainlink. Last week, that thesis got legal backing from the US government, a live $100 million fund from the largest asset manager in Europe, and a tokenized private credit product spanning 6 global markets all at the same week. This is the environment RWA tokenization has been building toward, with Chainlink at the center of all of it. If this video helped you understand better why this past week was so important, please drop a like and subscribe. I'll be following every development as this plays out. I'll see you in the next one. Thank you so much for watching. Cheers. Bye bye.